Valens Research, Uniform Financial Analytics.
Procter Gamble, we all know, right? They are a consumer products company that makes many of the things throughout your house, right? And so from everything from Gillette shavers to Braun products to various toothpaste that you use, etc. And so when we look at Procter and Gamble, one of the really interesting things that jumps out for us, one is it's a way more profitable business than as reported metrics make you think it is. On an as reported basis, you'd think that this was a 9% ROA business, which is not an impressive level of profitability for a brand business. Right? This company is a brand company. It should have high returns because otherwise, what are you doing? What are they plowing all this money into marketing spend, distribution, and everything else? They can't even have good brands. In reality, this is a phenomenal business with a 35% ROA. And it's not just that ROA is higher than as reported metrics make you realize, that as reported metrics make you think that ROA has basically been flat the last 5 or so years, when ROA actually moved up impressively in 2020. Right? This is a far better business and a more improving business than as reported metrics would have you realize. The really important thing, though, is that also doesn't mean it's a buy, because the next thing that we can look at is, again, what the market's pricing in. And what the market's pricing in here for Procter & Gamble is even more important. The market's pricing in continued ROA improvement going forward. Right? You would look at this company and say, we have a consumer products company that's pretty stable in what it's doing, and yet on an as reported basis, it's trading a little bit above market average valuations. What we would say is we have an improving business that's able to accelerate profitability, and that's why it's trading high. That doesn't mean it's a buy, though, because the market's pricing in ROA to continue to improve. And if we just think that this was a one-off releveling, well, Procter & Gamble might not be as interesting. Let's actually just take a look really quick at what this might mean Procter & Gamble is worth if we don't think Procter & Gamble is going to grow, because it really hasn't grown in the last several years, and we think ROA can plateau at these levels as opposed to continue to expand. So if we just say 35%, actually, let's just do this one, 36%. If we use the better expectation tool, quickly do this, what you can see is Procter & Gamble stock isn't worth $135. It's actually worth a decent amount less. And this is one of the really powerful things that we can do. When we're having a conversation, right, as an investment research team, when we're talking to a client, when we're modeling in scenarios, all of a sudden we don't have to pull out a complex Excel model that might have 20 different errors in it, which all of us who've built complex Excel models know have. We can just quickly do scenario analysis here to understand what's going on and realize if this company just has a ROA's plateau with no growth, it's worth 35% less than the current stock price for the company. We wouldn't even know to model that and say, model in the flat releveling of profitability, though, and understand what's going on if we were looking at the raw numbers.
Valens Research, the world's leading source for uniform financial analytics.